You pull up to the gas station, you turn off your car, and, you step out. You look up at the giant glowing numbers on the sign, and your heart just kind of sinks.
Oh, yeah. Every time.
Right. I mean, it is May 12, 2026, and the national average for a gallon of regular has just blown past $4.52.
It is a brutal threshold. I mean, when prices cross that line, it completely rewrites the arithmetic of a household budget. You really feel it.
Exactly. And because everyone feels that immediate visceral pain at the pump, politicians across the country are, well, they're rushing to the rescue with this very popular-sounding solution, which is the gas tax holiday.
Right. The quick fix.
Yeah, the quick fix. So our mission on this deep dive today is to figure out if these holidays actually save you money or if they're, simply a fiscal mirage.
Because it's rarely as simple as it sounds.
Exactly. So we've spent the week cross-referencing a massive stack of sources. We've got academic economic models from places like Penn Wharton and the Mosbacher Institute. We're digging through state tax guidelines from Avalara, the Indiana Department of Revenue. We're looking at news reports from CBS and WBIW.
We even have some on-the-ground citizen data sleuthing from Reddit, which is fascinating.
Yeah, the Reddit stuff is incredible. Welcome to the deep dive, by the way. We're going to use all this to understand the hidden mechanics of the gas tax.
Because the deeper you look, the more you realize that the price on that giant glowing sign is the result of this incredibly complex economic web. I mean, we all want to pay less, right? But understanding the machinery behind these political promises, it completely changes how you view a proposed tax cut.
Let's start with the catalyst, right? The reason we are staring at $4.52 a gallon goes straight back to the ongoing Iran conflict and the blocked Strait of Hormuz.
Yes.
We've got this massive disruption in the global oil supply chain, and it's happening at the exact same time as a massive surge in defense spending.
And the scale of that spending is really difficult to overstate. The Penn Wharton budget model, or the PWBM, they've been tracking the costs of Operation Epic Fury. And the U.S. government burned through an estimated $27.5 billion just in the first 32 days.
Wow.
Yeah, just through March 31st alone.
I mean, wait, that is nearly $1 billion a day.
Basically, yeah.
And the PWBM data shows a huge portion of that is driven by munitions. Like the military is firing Tomahawk cruise missiles that cost roughly $3.5 million apiece.
Right.
And that's alongside interceptors that run like up to $4 to $5 million each.
It adds up incredibly fast.
Yeah. I mean, when you are expending those by the hundreds in a matter of days, you are draining budgets and you're scrambling global markets at the same time. The conflict has essentially doubled jet fuel costs and sent regular gas prices into the stratosphere.
Which creates immense pressure on elected officials. They have to offer some kind of immediate relief to consumers, or at least look like they are.
Right. And we are seeing that pressure manifest across the entire political spectrum. I mean, CBS News reports that President Trump is calling to suspend the federal gas tax for a, quote, period of time. Meanwhile, you've got Texas Agriculture Commissioner Sid Miller, a Republican, putting out a press release praising the idea. He called it bold, pro-consumer leadership. And he specifically points out how crucial it is for farmers who are getting absolutely crushed by high input costs right now.
Yeah, the agricultural sector is getting hit hard.
And at the exact same time, you have Democratic lawmakers introducing their own legislation to pause or lower the tax. So the consensus is pretty clear, right? Everyone wants to pull this lever.
Because it's highly visible. The federal excise tax on motor fuel sits at 18.4 cents per gallon for gasoline and 24.4 cents for diesel. When your constituents are hurting, temporarily erasing that tax just looks like the most direct way to put money back in their pockets.
But mathematically, I mean, I'm looking at the Wikipedia source on U.S. fuel taxes, and there is a glaring issue with pulling this lever.
Right, the time warp.
Yeah. That federal gas tax of 18.4 cents, it hasn't changed since 1993.
Exactly.
It is not indexed to inflation.
Yeah.
Gas prices have surged over $1.50 just since February of this year alone. So let me ask you, if we erase an 18-cent tax that was set back when people were using payphones, does that even make a dent in the current price spike?
You're hitting on the absolute core limitation of a federal holiday. It is a very small dent that's essentially disguised as a massive rescue operation. And furthermore, logistically, a federal holiday requires an act of Congress, right? Which is a slow, arduous process.
Yeah, Congress isn't known for speed.
Exactly. So because of those hurdles, state governors and legislatures are stepping in and creating their own localized tax holidays.
Which creates its own mess. According to the tax compliance software company Avalara, This state-level patchwork is creating a total nightmare behind the counter.
Oh, a massive nightmare.
States like Georgia, Utah, and Indiana have already enacted these holidays, and Avalara points out that fuel sellers are being forced to update their point-of-sale systems, their tax engines, and all their accounting rules, like practically overnight.
Yeah, it is a severe compliance burden. Often, a state won't suspend every fuel-related tax, right? Just a specific one. So the software running the gas station's cash register has to be reprogrammed on the fly to separate out the taxable components from the non-taxable ones.
And I imagine smaller stations don't have huge IT departments to handle that.
Exactly. If a mom-and-pop gas station miscalculates, they could end up eating the tax liability themselves or, facing audits down the line.
But, okay, let's say the gas station updates its computers flawlessly. There is still a massive economic roadblock standing between that tax cut and the driver's actual wallet. And the Penn-Wharton models highlight this concept of the pass-through rate.
Yeah, this is where economic theory collides with everyday reality. So we naturally assume that if the government cuts a tax by 18 cents, the price on the street corner drops by 18 cents.
Right, that's what everyone expects.
But gasoline is what economists call an inelastic good, meaning your demand for it doesn't really change much when the price fluctuates. You still have to commute to work, you still have to take your kids to school, run your business.
You can't just boycott driving because gas is expensive. You're a captive audience.
Exactly, you're captive. And because of that, the suppliers and the gas station owners know they don't have to pass all those tax savings down to you. They can absorb a portion of that tax reduction to, pad their own profit margins.
Oh, wow. So they just keep it.
Yeah. The PWBM calculated this explicitly. They estimate a pass-through rate of 0.72 for gasoline and 0.60 for diesel.
Wait, meaning out of that 18.4-cent federal gas tax, consumers would only see about 13.2 cents of the drop.
That's right. The suppliers pocket the rest.
And for diesel, it's even more skewed. You said 0.60, so only 60% of the savings makes it to the person actually filling the tank.
Exactly. The system is designed with friction, and the consumer is the one who pays for that friction.
It's like getting a 20% off coupon for a pizza, but the pizzeria raises their base price by 10% the exact same day.
That's a perfect analogy.
You're getting a discount, but the house is still keeping a cut. And to see this friction in action, we have to look at the absolute mess that unfolded in Indiana.
Oh, Indiana is a brilliant case study in how complex these holidays actually are.
Truly. So on April 8th, Indiana Governor Mike Braun suspended the state's gasoline use tax. Now, the Indiana Department of Revenue's official guidelines make a very specific distinction here. They note the gas use tax is collected at the distributor level, not at the pump.
Right. And that structural detail changes everything.
Right, because it's like giving a landlord a massive property tax cut, and the government just, crossing its fingers and hoping the landlord decides to lower their tenant's rent out of the goodness of their heart.
Which rarely happens.
Yeah, there's no mechanism forcing that distributor to pass the savings down the chain to the gas station and then from the station down to the driver.
So to manage the optics of this, the Indiana Attorney General launched this public dashboard called In-Fuel Watch.
Right, I saw that.
Yeah, the stated goal was to track prices and reassure the public that the promised 17.2 cents per gallon in savings were actually reaching consumers.
But the most revealing part of this whole story is that it wasn't a state auditor who caught the system failing. It was literally a citizen data sleuth on Reddit.
I love this part.
Yeah, a user named Who's Your Thoughts started ripping into the data behind the IN Fuel Watch dashboard and found massive gaping discrepancies, like they physically spot-checked a station near their house. The state's official dashboard listed that station's price at $4.20 a gallon. But GasBuddy and the user's own two eyes confirmed the real price at the pump was $4.99.
A 70-cent discrepancy on the exact same day.
Yeah.
That indicates that the state's monitoring tool was essentially flying blind.
And the sleuthing went even deeper. Who's Your Thoughts looked at how the state was calculating the supposed savings. The dashboard claimed the pre-suspension baseline price was $3.93. But the state wasn't actually using that $3.93 baseline to calculate the consumer savings.
No, they weren't.
They were using the price from April 8th, the actual day the suspension went into effect, which was $4.13.
And the mechanics of that are just insidious. Because news of the tax suspension leaked early. So gas stations preemptively hiked their prices by 24 cents right before the holiday actually hit.
Oh, so then when the holiday started, the prices came down slightly.
Yes.
And by using that artificially inflated April 8th spike as the starting line, the state's dashboard made it look like distributors were passing on these huge, generous savings.
When in reality, they were just coming down from a synthetic peak that they created.
Yeah. When Hoosier Thoughts controlled for overall national market trends, the math showed that during the first 3 weeks of the holiday, Indiana consumers were only seeing 6.29 cents of the promised 17.2 cent savings. The distributors and stations quietly absorbed all the rest. I mean, why is it up to a random person on Reddit to figure out if we're actually saving money? Doesn't this show that these state monitoring tools are sometimes more PR than practical?
It absolutely illustrates the vulnerability of indirect tax cuts. I mean, if the state loses visibility into the supply chain, the policy becomes a public relations exercise rather than an actual economic relief package. However, to be fair, the dynamics in Indiana eventually shifted.
Right. Governor Braun realized the lever wasn't working. According to a May 11 report from WBIW, he updated the emergency declaration. He extended the suspension of that messy gas use tax, but he also brought out a heavier hammer. He added the gasoline excise tax to the holiday.
And that addition fundamentally altered the math at the pump.
Yeah, the WBIW report notes that once that secondary tax was suspended, Indiana prices finally cratered. They dropped by 46.5 cents over a single week, bringing the state average down to 4.36. I mean, Indiana completely bucked the national trend of rising costs. So it seems like with enough brute force, a state can temporarily bend the price curve.
They can. But bending that curve introduces the next crucial layer of our deep dive here, because even if you manage to force the savings all the way down into the driver's wallet, that money has to come from somewhere.
Right.
The taxes being suspended are not just sitting in a vault. They are the lifeblood of physical infrastructure.
Yeah, and the Indiana Chamber of Commerce issued a stark warning about this exact trade-off. They calculated that suspending the state fuel tax drains almost $500 million in road funding revenue per quarter.
$500 million every 3 months.
It's staggering.
And the mechanism of how that money disappears is brutal.
It really is. It's a cascading failure. The chamber outlines how this halts repairs on 500 lane miles of road. It puts 7,000 construction and maintenance jobs at immediate risk. And honestly, the most damaging part is that state aid funding is often required to unlock federal matching funds.
That's the kicker.
Yeah. If the state pauses its tax collusion, it doesn't have the capital to trigger the federal match. Meaning, Indiana risks losing out on a portion of the $1.2 billion it receives from Washington every year.
And the federal numbers mirror that same vulnerability. If Congress were to enact the 4-month federal gas tax holiday being proposed, the PWBM calculates it would cost the Highway Trust Fund roughly $11.5 billion.
Wow.
The Highway Trust Fund operates on this very delicate cash flow balance, and wiping out $11.5 billion evaporates about 19% of its entire annual spending in just 120 days.
That's wild. You are basically trading tomorrow's bridges for today's gas receipts. And beyond the crumbling infrastructure, Patrick DeHaan, he's the head of petroleum analysis at GasBuddy, he pointed out a massive macroeconomic trap waiting for us in all this.
Yeah, his analysis focuses on the danger of manipulating demand during a genuine supply constraint.
Right. He notes that dropping the price at the pump stimulates consumer demand. People feel, less pressure to carpool, less pressure to cancel road trips, less pressure to consolidate errands.
But we are currently in the middle of a global supply crisis because the Strait of Hormuz is blocked.
Exactly. So dropping the price during a supply crisis is basically like turning the air conditioning on full blast when you know the city's power grid is about to fail.
That's exactly what it is. You are artificially masking the severity of the shortage from the consumer. See, if the price reflects the reality of the choked supply chain, consumers naturally ration their usage.
They stay home.
Right. But by lowering the price through a tax holiday, you incentivize people to burn through a constrained resource much faster, which just accelerates the timeline toward localized fuel shortages.
Okay, so we've mapped out the logistical nightmares for gas stations, the pass-through math, where distributors pocket the savings, the hidden costs to our infrastructure, and the danger of stimulating demand. But, I gotta say, the most counterintuitive piece of data in our entire stack of sources comes from human psychology.
Well, absolutely. It flips the entire stated purpose of a gas tax holiday on its head.
Because the fundamental political pitch for a tax holiday is simple, right? It's like, quote, we lower the price of gas, you keep more of your paycheck, And then you take that extra cash and spend it at local businesses, stimulating the broader economy.
Right, that is the conventional wisdom behind almost any consumer-facing tax cut.
But a study from the Mosbacher Institute looked at real-world consumer behavior during previous gas tax holidays, and they found the exact opposite happens.
It really is mind-blowing.
Yeah, they analyzed states with high pass-through rates, meaning the policy actually worked, and gas prices really did drop significantly for the consumer. In Maryland, the pass-through rate was 0.83, which resulted in a 29-cent drop at the pump. But total consumer spending in Maryland didn't go up. It actually decreased by 0.95%.
And they compared that to a state like New York, which had a 0.00 pass-through rate.
Right.
So in New York, the distributors absorbed everything, pump prices didn't drop for drivers, and consumer spending remained entirely stable.
Wait, let me just unpack this because it sounds crazy. The government successfully puts extra cash in your pocket to stimulate the economy, and your brain responds by locking that money away in a savings account.
Pretty much. To understand why, you have to look at how humans perceive inflation. Gas prices are utterly unique because they are highly visible. We see them on giant glowing signs on every single street corner.
Yeah, you can't escape them.
Exactly. For the average person, the price of a gallon of gas serves as the ultimate psychological benchmark for how expensive life feels.
Like if gas is up, everything feels expensive. If gas is down, the world feels a little more manageable.
Precisely. So, when a tax holiday abruptly drives the price of gas down, households subconsciously lower their overall inflation expectations.
Okay.
Now, normally, high inflation acts like a ticking clock. If you believe your dollar is going to be worth less tomorrow, you are highly incentivized to go buy that new refrigerator today, right? You spend the cash before it loses its purchasing power.
Right. But when the gas station sign drops by 30 cents, your brain stops the ticking clock.
Exactly. Economists call this a perceived increase in the, quote, real interest rate. The real interest rate is essentially the nominal interest rate you get from your bank minus the rate of inflation. So when you feel inflation cooling off, your cash suddenly feels like it's holding its value better sitting in the bank.
Oh, so the urgency to spend disappears.
Yes. This subconscious shift encourages people to delay their discretionary purchases and save their money instead.
That is fascinating. The government pulls a lever, intending to spur retail spending, and instead, our brains interpret the cheaper gas as a signal that the economy is stabilizing, so we quietly tighten our belts and hoard our cash.
It is a profound reminder that taxes are not just mechanisms for raising revenue, they are these invisible strings that direct human behavior. Any adjustment to the tax code sends a behavioral shockwave through the economy.
And another source in our stack from the Penn-Wharton budget model illustrates this beautifully with income taxes. They modeled what would happen if the government lowered the cap on itemized deductions.
Right. The model looked at lowering the cap from 35% down to 24%.
So, to put that in plain English, right? If you are a high earner, you currently get a significant tax break for things like donating to charity or paying mortgage interest. The PWBM shows that if the government caps how much you can deduct at 24%, it would raise a staggering $475 billion in revenue over 10 years.
It's a massive amount of money, but the revenue is almost a secondary effect.
Really?
Yeah. The primary effect is the behavioral shift among the top 20% of earners.
Right, because if the tax benefit of donating to a museum or a university is suddenly slashed, high earners will instantly alter how they allocate their wealth.
Instantly.
The entire nonprofit ecosystem would have to adapt overnight, just because a single percentage cap in the tax code changed the behavioral math for wealthy donors.
Exactly. Just like the gas tax holiday alters our perception of inflation, every single tax policy is secretly a behavioral engineering tool.
It's incredible.
A policy that sounds incredibly straightforward on a campaign flyer is infinitely more complicated once it hits the real economy.
So let's just step back and look at the whole picture here. We started with $3.5 million Tomahawk missiles, depleting budgets, and a global conflict blocking the Strait of Hormuz, driving up costs at your local pump.
Right.
We looked at federal proposals trying to erase a tax that hasn't kept up with inflation since 1993.
Right.
We watched the states step in, creating an absolute nightmare for the software running cash registers.
We examined the pass-through friction, where distributors quietly pocket the savings.
Leaving it up to Reddit users to fact-check state governments.
Yep.
We tracked the cascading failure of paused road funds risking 7,000 jobs, the danger of encouraging people to drive more during a global fuel shortage, And finally, this psychological quirk where cheaper gas tricks our brains into spending less money overall.
It really challenges the very premise of what an economic fix is supposed to accomplish.
It really does. And it leaves me with one final thought to mull over as we wrap up this deep dive. As we discussed, gas prices are entirely unique because the taxes are baked into the price, and they displayed on giant neon signs on every street corner in America. We are hyper aware of exactly how much gas costs every single day, which is why politicians are so terrified of it.
Oh, they're petrified.
Right. But imagine for a second if our other taxes work that way. Like if the exact real-time cost of your income taxes or the daily compounding cost of your property taxes were posted on a giant neon sign on your front lawn every single day for you and all your neighbors to see.
That would be wild.
How differently would we behave? And how much faster would we demand the machinery of our economy change?